Hello everyone, my name is Vinny Rasil. I am an instructor with Accounting 1040, and this is a tutorial on E10-22. This is one of our comprehensive problems, so we're going to work through all the steps in this problem. So let's get started. So the first thing I'm going to do here is I'm going to switch screens so that we can take a look at the problem in Excel, and let's review it together first thing here. All right, just getting things squared up here. Okay, so let's take a look at the problem. You can see it here in Excel. So the serial exercise here involves a company that will be revisited throughout relevant chapters. So this is a problem that's been ongoing. You've seen in previous chapters. So this is a continuation essentially of that problem. This exercise continues with Canyon Canoe Company situation from chapter 9. You don't have to complete the prior exercise, so just focus on this problem and the information that's listed here, and don't worry about previous information listed in here. So Amber Wilson is continuing to review the business practices of this company. Currently, she's reviewing the company's property, plant, and equipment, and has gathered the following information. So she's got this chart. These are the assets. This is the acquisition date, costs, estimated use of life, residual value, amortization method. Let's make sure we all understand these short forms here. Straight line method, double declining balance method. NA is not applicable. Monthly amortization expense. So what do they want us to do in this problem? Let's just shrink this up a little bit so we can see. They essentially want us to calculate the amount of monthly amortization expense for the computer and office furniture. Monthly is the key word here. Each asset determine the book value at December 31st, 2020, and then 6 months later in 2021 at June 30th. And then prepare a partial balance sheet showing the property, plant, equipment as of June 30th. So those are 3 requirements they have for this problem. Now let's work through the steps to basically resolve this problem. I'm just going to move behind here to get all the steps. So I've listed the problem out here, and then I've basically broken out each step in here so that you can actually see. Just going to reshare to make sure you can still see it here. So let's take a look at requirement number 1. Requirement number 1 involves calculating the monthly amortization costs of the computer and office equipment. The asset that we're listing here is the computers. The method is double declining balance. How do we know that? They told us right in the problem. So this is a little chart. I'm just going to keep this close here for the purposes of reviewing. The life of it is 3 years. It tells you right in the problem. Residual value is $300, again given. Cost is $3,600 given. The date purchased is March 2nd, 2021. In this problem, it says to calculate the amortization for 2020. I think this is actually a typo. What they probably mean is for 2021, considering you purchased it in 2021. So let's move forward with that assumption because that probably pretty much fits how we're calculating the problem. So what are we doing here? We're going to calculate the amortization using the double declining balance method. So the first thing to do is to break into the formula here so that we understand what's happening. I'm just going to move the problem over. So the amortization is basically the cost minus accumulated amortization times 2, and then to basically get 1 divided by the useful life here. And then what we're doing is we're calculating it by 1/12, which is the monthly cost. So let's plug in those numbers. We have $3,600 as the cost, times 2, times 1/3. Why is it 1/3? Because they purchased the computer in March, which is basically 1/3 of the years through, and then you're multiplying it by 1/12. The calculation works out to 3,600 times 1/3 times 2, which is double declining balance, times 1/12 to get a monthly cost of $200 per month in year 1. So fairly straightforward if you understand the formula. The only part that's probably a little bit confusing is that it's prorated for this year, March being basically only the 3rd month, and you got to get a monthly cost, not an annual cost. So 2 key things to watch for in the problem. Let's look at requirement number 2, which is basically the monthly amortization of the office furniture. So similar here, I spelled furniture wrong here, so let's correct that. Furniture. There we go. And method seems to be missing a D. So we've got furniture. The method is straight line depreciation. How do we know that? They've given it to you in the problem, straight line. They've said it's going to last you for 5 years. Let's just move this over so you can grab all the information. 5 years, $3,000 cost, $600 residual value, date purchased is March. So again, all the facts pulled over into one area, nothing different from the last problem that we reviewed. Let's take a look at the formula for the straight line depreciation. Cost minus residual divided by the expected life times the number of months. Okay? Fairly straightforward. So we've got 3,000. Okay? 3,000 is the cost. This is supposed to be minus. Okay? But minus the $600 times the 1/12. You're dividing it by the number of years, which is the 5 years as well. So the cost minus the residual of $600. I think I've moved this over to one cell. So let's put this over here. So 3,000 minus the 600 divided by 5 times the number of months. Okay? And then times the 1/12. So that works out to, let's look at the formula. 3,000 minus the 600 divided by the 5. And you're taking that and dividing it by, multiplying it by 1/12 or dividing it by 12. Same thing. You're coming up to $40 per month. So again, really, really straightforward exercise here. Really, really easy to calculate straight line. Double declining balance, the only sort of trick here is you're not deducting the residual value and you're multiplying it by 2. So those two requirements are out of the way. Let's get into the more challenging requirement here, which is number 3. The book value as of December 31st, and then the amortization schedule and book values of June 30th. Let's tackle the first one here. The first one is basically for December 31st. So what I've done is set up a chart for this to make it a lot easier. And I've taken the information that they've given to us and then just basically plugged it over. So let's pull this chart down so we can compare facts here. So you've got canoes, land, building. We don't need canoes twice here. So actually we do have canoes twice. That's not true. So we have 2 different canoes here because of 2 different dates. That's why November 3rd and then December 2nd here. We've got the costs that are given to us at $4,800, $85,000, $35,000, and then a different cost here of $7,200. All of this is given. The monthly amortization, if you look over here, is actually given to you for these 3 assets. Let's tackle what we're doing with land. Let's move back over here. So there's no amortization for land. Why? Because you don't amortize land. Think back to the slides and the lessons, we don't amortize land. We've got date of acquisition here broken out, again, given to you, months amortized. How are we calculating the months? If this is purchased on November the 3rd and we're doing this amortization chart for December 31st, that's 2 months of amortization. If this is December 1st and we're doing it for December 31st, 1 month. And then for the purposes of simplicity, this is also 1 month. So then we're calculating how much amortization we've accumulated. And all we're doing is taking the monthly amortization multiplied by the number of months. Same here, same here. Really simple formulation. So what's the book value? The cost minus the accumulated amortization. Really straightforward. Why is this the same as the cost? Because there's no amortization. So we just move down the chart to calculate the book value. That's the first portion of that requirement number 3 done. The next one is to then calculate the accumulated amortization and book value on June 30th. This gets a little more complicated, but I think we can manage it. So once again, a chart for simplicity. And what do we have broken out in this chart? We have the assets, the cost, accumulated amortization at December 31st, which is just the same chart here, book value at December 31st here. So sorry, this is the accumulated over here, book value from December 31st here, monthly amortization expense in 2021, how many months amortized, accumulated amortization, and then book value. So we're essentially taking the December 31st chart, dropping it in here, and then adding in what we would do for 2021. So again, easiest thing to do first is to take all the information that's already been given or calculated and drop it in. Canoes, land, building, canoes. Drop all the same information up here, down here. Same thing for accumulated amortization. The 200, 500, or 150 are straight from here. So nothing complicated if you're just dropping information from one cell to the other. So same thing down here, same thing here. Okay, fairly straightforward, nothing complex about copying and pasting. Book values, 4,600, 85,000, 34,500, and $7,050. Again, you're copying from here to here. So for simplicity, I'm just going to copy this arrow over so you get the point. Okay? Monthly amortization expense in 2021. We've been given the monthly amortization. It doesn't change. Monthly amortization is $100, $500, and $150. But then we have these two assets that we calculated in requirements 1. So we have computers and office furniture purchased in 2021. Remember in March? So we're going to take that data, the original cost from the chart above. Remember up here? We're going to drop that data in. We're going to drop the monthly amortization expenses. Where did we get this 200 from? We'd calculated it way up here. That's the 200 up here. Where's the $40 from? Again, calculated up here. Let's go back and find our $40. There it is there. So again, you're taking those numbers, transcribing them down in the bottom. Now you have months of amortization from January to June. Why is it 4 months and not 6? Well, because you purchased these assets at the beginning of March. So count your number of months so that you understand how to get from January to June, how many months you basically utilize. And so to calculate your accumulated amortization, you're multiplying the monthly expense by the number of months. This is just following a calendar. That's all you're doing here. Multiplying through and then book value. Let's get to book value to be sure how we understand how this is done. So for the first asset, canoes, I've taken the book value from December 31st and deducted the amortization from January to June. Same thing for this asset, or land, there's none. Same thing for the second, the building, and then the next set of canoes. What have we done for the last two assets? We've used the original cost. Why? Because there was no book value in December 31st. So you're taking the original cost minus accumulated depreciation to calculate the book value. Just going to make this correction here. So you can see here, fairly simple calculation. If you plot out your information at the top and drive through your calculations, the charting becomes really simple just to fill in the blanks. The last step of this problem is working out the journal entries. This is a sort of a partial balance sheet, which is really just this asset section of the balance sheet that you're working on here. The reason they call it partial is because you don't have any liabilities here or equity. So let's take a look at what we've done here. We've got property, plant, and equipment as a section of the balance sheet we're referring to. We're going to record the land as a debit. Why? Because it's an asset that we're putting onto the balance sheet. Building of $35,000 less the accumulated depreciation to get the net book value. Same with the canoes, same with the computers, same with the office furniture. There's a credit of $132,000 of $290. That's basically total property, plant, and equipment. It's not really a credit, actually. This is just a summation of these. So all this is doing is summing these pieces here, okay? Let's take a look and add our sum, $132,290, $132,290. So this is essentially the portion of the balance sheet that you're recording, and you've got a layout here of how this all works. Let's take a quick recap of all these steps here. So the first one is to make sure we get all of our facts laid down, our method of amortization, and ensure that we know how to calculate it by month. How are we doing that? We're looking at purchase date, and then we're doing it by 1/12. Step 2, again, we did this for using the other method of depreciation, which is, in this case, straight line. At the top was double declining. Then we gathered the facts here for book value to basically create a chart. The chart for book value, asset, cost, monthly amortization, date. That's just going to help us calculate the number of months amortized, or track the number of months amortized, accumulated amortization, and book value. And then we just basically expanded the same chart for the next 6 months. Last piece was the journal entries. So there you have a pretty good recap on a fairly comprehensive problem that involves a number of steps. We've got 2 different methods of amortization. We have accumulated amortization. We have amortization on a monthly basis, not annualized. We have book values happening, and then we have journal entries happening for a multitude of assets. If you can get through this type of problem, you're certainly going to be well prepared for a testing scenario. So hopefully this helps you put into practice some of these as you work through the other problems.